Hello and welcome into this stream. If you're following this video, this is a market review of what's happened today in the session. I'm gonna make some live videos where I start taking trades and stuff, but I'm just more, as it's a new channel, I'm not that confident with publicizing everything as I'm trading, and I prefer to just be in my own mind whilst I'm trading at the moment. But as I gain more confidence and stuff like that, we will look to live stream this. I've just done one of the worst things on earth, which is going to TikTok and you see other people live stream and how they do things completely different to you. How some people do it right or they've got the same sort of idea, some people do it completely different. Um, which is fine. But there's a lot of people who think they know absolutely everything, which is I'm not one of those people that think they know absolutely everything in trading. But I'm like a beginner in my journey, just starting to turn profit. I know what I'm doing, but my biggest challenge is my emotions and things like that. So yeah, a lot of people on there who are good traders, I've realized have really good emotions, have really good like risk management and stuff. So I'm going to really focus on that in my own training. um, in terms of reading the markets, I think I'm pretty good. But what I have noticed as well, a lot of people not using the 1 minute chart, a lot of people not using the 5 minute, and some people just using the 15 minute, and it's fine. They're profitable and things, which is good. So hats off to them. But the way I look at it is in like if you're watching a TV, you want the highest resolution, yeah. So if you're not down on the 1 minute, on the 5 minute, and stuff like that, and looking at that, what your stop loss is like massive. You're taking like one to ones and things like, so you're not taking that positive risk to reward ratio. So the way I say it is you should definitely be looking at the 1 minute chart. You should definitely be looking at the 5 minute chart at least, and the 15 minute chart. You don't really need more else than that, and then daily levels on the daily chart. Other than that and the ICT concepts, you don't need anything else. You should be able to read price action off a lower time frame chart if you know where price is heading. So yeah, my opinion on that is quite strong. Um, but yeah, I want to really come across to you guys as someone who really wants to help people learn, who doesn't know everyone and bash everyone else's trading. Because at the end of the day, if they're making profit, they have an edge in the market. Yeah, I think the best way to look at it is that you need to be looking at lower time frames as well. If you really know what you're doing, like using these concepts, look at the lower time frames because you can see more clearly what's going on. One 15 minute candle is like 15 minutes and stuff. And I'm also noticing with other traders on TikTok, things like that, they're not having any ICT levels. Like for example, they didn't know why it stalled here and they didn't know why it's told here. Well, you wouldn't looking at this. You just think, oh, it's going up or it's going down. So a lot of traders are like that. But why? Why did it stall here? And we'll come into that with the market review now. So this is the I'll add the sessions on first, which you should be aware of. So you've got the three sessions. I will zoom out and go to the 5 minutes to start with. So this is what's happened so far on the 4th of June candle. So yeah, it starts at 3rd of June because that's when we open, but this is the whole candle that forms the 4th of June. So as you see here, um, we're looking at this as the three sessions. So you've got that out first. So people knowing when to trade is fine. Everyone's trading the open, which I was watching people trade. Um, yeah, so I was watching people trade that. I'm just trying to work, like, sort of see about mindset and stuff because that's part of my journey. That is my weak point, is my over trading, things like that. Which if you start to join my streams and stuff, you should hopefully see me try to improve on that. But yeah, in terms of actually about the market and what it's doing, I can really give you a good overview. So let's get into it. So we're going to do the New York session here, mainly focusing on. So again, no one's using these levels that I'm using on the chart unless you're deep into ICT, yeah? So that's what you need to be into. So let's add on the new day opening gap and new week opening gap levels and then go to, let's leave them off actually. We'll go to the daily first. So on the daily chart, what was I looking at? Well, numerous things you can highlight looking at this. So it's prior to this candle. What are we looking at in here? We've got a load of wicks, but I'm mainly focusing on everything to the left of this. Okay, so I'll highlight some key areas, which is the ones we've talked about in the free beginner series, which is the volume and balance here. You see it? Because we opened lower, I'm not really interested in this wick so much. I'm more interested in this wick. So if you were to grade it from high to low, this long wick, we can see how it reacts. Sorry, let's take these levels off. You want to have 0.25, 0.75, and then you go across like that. And then that would be the two levels, and then we got volume and balance here, which I could highlight as well, like that. Okay, so them are the three levels that you could kind of expect the reactions of. So I should probably have labeled them as well for you. Also, I appreciate not many people are watching this channel yet, and it's nothing that phases me as such, because I know the content I'm producing might not be the most entertaining person in the world, and I might not be the most fun to sort of watch. I'm not like doing big like showboating things, and I'm not like saying join my Discord. I'm not saying any of those things. So yeah, we might get to a point where eventually we have a Discord, but again, I'm not going to push it at all. I'm just going to have it there. People who want to join. I'm not someone who's going to be pushy and trying to make profit from people in that way. As part of me on this journey is wanting to help other people. Okay, and again, it's not all about money. I would think about doing a mentorship and stuff eventually, but like I don't really see the point at the moment, especially with the views so low and things. But eventually that's where I want to get to. But again, I'm not going to push people into that at all. So I just want to put all this information out there for free, um, and then yeah, see where it goes from there. I really want people to find value in all these videos. And it's quite difficult, but I'm on my journey of like trading. I'm on my journey with this as well. So yeah, it's like you're following like someone who's not really I wouldn't say not good at trading, but you're following someone who's new to like the whole social media and everything like that. So we'll see how it goes. Again, as you can see, I do really want to help people, and I'm not making false promises to people, and I'm not giving signals because I don't believe in giving signals. I want people to be independent thinkers, and that's the main goal of everything. Okay, is that I'm trying to teach you how to trade. I'm not teaching you how to copy trade. There's no one. You want to be self-reliant, not on someone else. Okay, so let's see how it's used, these levels that I've highlighted now. If you go to the 1 minute chart and we go to, it's traded down all day, yeah? So you'd expect some sort of reach up back into these levels. So we're trading between the two. The chart like this you can see, but I'm mainly going to show you. So when the market opened here at 9:30, admittedly I was bullish on the day when looking. So these levels are the levels I've highlighted, the volume imbalances. two volume imbalances. We have got, and we have got the New York session, the London session, and the Tokyo session. And then we're looking for like liquidity and stuff around here. So what's the market? I was bullish on the day because if you look, we've traded so much lower that it would want to offer some sort of like everyone's been profitable here, all from here. Who's gone short from London? This massive drop all from London. Like they wanna disturb that, okay, during this session. Just trade lower. I thought possible, but I wouldn't favour that. Like I was like favouring some sort of coming up into this liquidity. Um, so yeah, I'll show you like what the market did. So it's traded higher, took out this liquidity, then it's traded lower, took out this liquidity, and I'm on the 1 minute time frame, not the 15. So you can see that on the 1 minute. So you got these highs, this high. So that's like retail support resistance. So it's traded higher, and then it's traded lower into first presented fair value gap. Traded lower, took out this liquidity. So that would have been a potential short. Seeing that, I wouldn't have took that because I was long on the day. So yeah, let's add more detail to the chart. So you think this is complicated, but it's adding detail, and without the detail, you're not going to know what the hell's going on. So look at this level. Look at this level. Sits between the volume imbalances, but also look how it trades up to that volume imbalance. It's like a take profit. But also look when we add on the new day opening gaps. We're hovering. Okay. Then we come up, touch new day opening gap, come down, touch new week opening gap. So we're moving from the new day, new week, yeah, go up. So you see how the new day opening gaps where the candle closes at 5 p.m. and then opens up at 6 p.m. Eastern time. So I have 5 of them on my chart. 1, 2, 3, 4, 5. They're like magnets on price. So like I'm potentially looking now, we've got these relative equal highs and a new day opening gap. So I'm seeing in the lunch hour, can we go higher and potentially flip this candle into a bullish one? Okay. So again, like when it gets to here in lunchtime, people start seeing this. Zoom in a bit, and they start going short because they start seeing what. If you were to look at this without knowing any of these levels in your chart, you would see like struggling to get up, coming lower. But what you've got to wait for what the macro time, which is 11:50 to 12:10, and we're unwilling to go lower at that time. So this was just a little retracement fake out to engineer what relative equal highs to go up again. Same here, relative equal highs, engineering that, oh, it could drop. No, it's going higher to take out these relative equal highs. Down here, it's what? Trapping people to go short. But what it's doing actually is come down just to take the liquidity. And then what time are we? We're at 9:50. 10:10. That's where your entry is to go up. Okay. So everyone who went short, it took out, and then it reaccumulated short positions down, took out everyone who went long and held, and then we basically this would be the Judas swing, like trapping in a lot of short sellers after 9:30, but it's actually also a liquidity target to target everyone who was long prior to 9:30. So it's doing both. It's taking out every bit of liquidity in here. That's why, unless I'm really, really confident, I don't like to keep a position on over the open. The time is important. Again, I was listening to someone on live stream today and they're saying, "Oh, I just have my fixed TP stop loss, and then it doesn't matter about the market open." It completely matters about the market open because at the market open, they're hunting out the stop losses, they're hunting out the orders. So for example, here, where you're thinking, yeah, it's going up, let's hold, or let's enter here, but because we've come into what? So if you have a look, not 8:50 to 9:10, you think it's going higher the macro time, but it just fucks you over when you get to the open. So no point holding through the open unless you've got strong conviction of that. So yeah, you want to enter after the open usually, because usually what it does, it like just before the open, it'll trade one direction, thinking everyone is gonna boom down at the lower, but then it'll just always like whack you out. Um, anyway, let's talk more about the levels. So you've got an entry here, trades to this level, trades to this level, trades to this level. All these wick gradients. If you look at the red lines, look at when we go up, we respect it. We respect it in the macro time. Yeah, we're not we're not breaking below, like down towards the next level because we're bullish. Yeah. So we're using these levels as we move up as like, you could almost use them as targets, you could use them as like your true support and resistance, is what I've said before, as well as these new day opening gap, new weakening gap. There are support and resistance. Bearing in mind as well, you're looking at the opening range gaps, which overlaps, which is like the closing price at 4:15 on regular trade now, at opening price at 9:30 on electronic hours. Hits what? Upper lower quadrant, trades down, takes the liquidity. Once it does that and displaces higher, it's aiming for what? The middle. And the middle is like is usually 70% chance of hitting it before 10 o'clock. So what, we've manipulated a lot of traders here. And again, we're manipulating traders here into short. So you've got to think about how you're manipulating, how traders are being manipulated in the market. If you're not thinking about how traders are being manipulated in the market, there's something wrong, because you're playing a game. If you're playing poker, you want to know how they're playing, bluffing each other, yeah? So you want to see what other people are trying to call their bluffs. So for example here, they're trying to bluff you into going lower. But we've entered the macro time at 9:50 to 10:10, and we've displaced higher, we've took liquidity, we've not filled this opening range gap, we're below midnight price, everything screams at me bullish here. Okay, you've got fair value gap here on the 1 minute. Admittedly, you don't get the lower one, so but if you're very confident, you could have entered here. You could have entered as the price closed through the inverse fair value gap. And once price gets here, you definitely know we're the lower quadrant of that wick. So I'll show you again on the daily chart what I've got mapped out. So if you don't have this mapped out, you're far behind everyone. This is why ICT is so good, because it's not, when we're looking at high resolution, I don't need to keep flicking back between different time frames because it's not important. If you understand price, you can see it on the 1 minute. So you've got what? The volume imbalance, yeah? And I've graded this wick. You could have also graded this wick as well, yeah? The big long wicks are called tails, so you've got to grade them. Look at that wick, yeah? It's a discount. It's come down for discount, so you've got to look at what's discount. You've also got, which I probably should have looked at, which I didn't even highlight, but you could have, is this fair value gap on the daily chart. Oh, is it fair? Oh no, I can't see that. No, you've got this wick, sorry. It looks like a fair value gap, but no. You've got this long wick, so I've graded that wick. It's correct. So we're here. So 9:30 opens, displays higher, takes out everyone who's gone short prior, thinking it's going to go down for the day. Then it comes back down, taking everyone who's long here, wicks them out, and then the real move starts. So the real move starts down here, and look what we've had for the whole day. If you were to put an order on this, you'd have a long position. If you're extra confident here, you don't need to be super like prestige with your entry. As long as you know where the market's going, that's the main thing. But you want to enter on the low of this wick. But because there's two fair value gaps, you have to place your stop loss below the low of number 2, yeah? So you're looking at that. And then you're targeting, you could hold this for the whole day if you wanted. But ultimately you're targeting the lowest hanging fruit. So that would have been your 1.52 to 1. And then ultimately up to the middle of the, or you could target the new day opening gap. You could have targeted all the way up, yeah? 2.78 to 1. Again, sometimes this is why I would have preferred it to like just have one fair value gap, because then I could have entered with a smaller stop loss. But when this happens, you just have to accept it, or improve the skills where to the point where you will spot on this inverse as a key inverse fair value gap, and then entering off of this candle, kind of like this, and having that entry with no drawdown whatsoever. And then you get a bigger risk to reward ratio by doing that. But again, this is just a point to prove you don't need to be perfect with your entry as long as you spot what you're doing. Anyway, going back to what I've got on the chart. So you've got the new week opening gap, high and low, new day opening gaps. So I always keep 5 on my chart. Let's remove the big blue zone for now. So there's an indicator. If you go to indicators, I'll show you, these are all the ones I have. Okay, I don't use any others. They're not really indicators, they're just highlighting levels on the chart. So you've got the new day opening gap. That's when the price closes at what the day it closes at what? 5 p.m. and it opens back up at 6 p.m. Okay, the next day. So that formulates the daily candle, and these gaps that occur between are like magnets on price. And every TikToker I was looking at today didn't have these levels on, so they're confused to why, for example, it's spending time there. Why does it come back down here? Well, it's gravitating to in between them. Yeah, it's working between these levels, the same as the levels with the gradients of that wick. Look, it's touched the wick. What quadrant's that? The lower quadrant come through. Can't even reach the consequent encroachment, which is the middle. Then it trades above, touches upper quadrant of the wick, comes above, and look, touches the top of the wick. So it's clearly using these levels as part of the algorithm, but no one will believe it, which is fine, because if they're still profitable, they're still profitable. But I'm trying to help you is find an easier way to be sure of your trades. So yeah, you could have got in a lot of time on this upward momentum, and as long as you're using these as your targets and things, you're completely fine in the trade. So yeah, you've got a little trade down, and you've got that big trade up for the day. So there's 2 trades you potentially could have got a lot of profit out of. But you want to trade in time with your higher time frame bias, which is long. Yeah, because let's move on to the next concept, which is your opening range gap. Yeah, so let's remove the new day opening gaps now. So your opening range gap is the gap that occurs between 9:30 and this is 4:15 price. So I've got this on an indicator, but if you go to down here to the bottom right of your chart and put this at regular trading hours, it's basically this gap. So that's where we closed at 4:15. You see at the bottom of the chart where it says 4:15. This is where we open at, what time is this? Sorry, 9:30. And usually 70% chance of this gets hit within the first 30 minutes. But because the gap's so big, it's potential we're not going to get that full closure of the gap, or it's potential we're not going to hit the upper half of the gap within that before that 10 o'clock. But you go back on your charts and look, before 10 o'clock that normally gets hit. 70% chance, and I back tested it, and it's roughly 70%. I've got 68%. ICT got 70%, but it's pretty close, yeah. So you want this gap always on your chart. So I use the indicator called opening range gaps TFO. So then I can just stay on electronic trading hours and see all the prior price action as well as all of this. Okay, so I'm overlapping all these ICT concepts, and then I'll highlight with you like the macro times. So I'll get a little trend line going. So I'll show you like all entries that you could have took, even if you didn't get this bottom one. So you got 950, 10, 10. So in this time, the market changes. Let's have a look at the next one. 10.50 to 11.10. That's when the market's going to start moving. So people were thinking, oh, why is it taking so long? Well, it's because we're not in a macro time. So someone like, for example, exited their trade, even though they were in it, like they got in it correctly. Like if you're an ICT basic, like beginner trader or whatever, or even you're making money or whatever, you could think, oh, well, this is coming down. We've got the inverse fair value gaps, took liquidity, let's get in. And then they start seeing this and they start panicking. Oh, why is it taking so long? Because we haven't hit macro time. It's engineering liquidity. So we've got relative equal highs. Like it's trying to trap people in all the time. You've got to think there's two sides of every trade. You've got the buyers, you've got the sellers. So what are they trying to do to get more people to sell? So then we can take their stops. That's all it's doing. It didn't displace lower. It didn't break through this upper quadrant of the wick, the PD rays. It didn't do any of that. So it wasn't showing me any signs here it was going to be lower. Don't try to stop up too tight. Don't be greedy in that, because that's when, if it just did a little manipulation down to here, I would have warranted that stop loss. Once it moved away up here, could have been at break even. That's fine, because I wouldn't have expected that break below. Just don't move your stop up too tight, otherwise you will get punished. And again, look how it reacts off that 50% level, off that volume imbalance. And it's just for a retracement. And then we'll add these back on. Now it's at midnight price. Here, bang on midnight price. And you get reactions off these levels, but it doesn't always mean it's going down just because it presents itself as a little reaction. Again, we're working inside this nude opening gap, so things can take a bit longer there sometimes. You can gravitate below, but we're going up towards this one now. Okay, but it might just take a bit longer because we're at that nude opening gap. So when it stalls, that's fine. It's an area where a lot of people are putting orders in and things like that. These are like key zones almost between it. So what other things do I have on the chart? I have the only other thing that I've shown people is the 5-day ATR tracker, which is basically, I don't use this a lot, but all it does is it shows you if you hit the high of the day, it'll basically call blue. So like for example here, it's an ICT concept. It's not like an indicator as such, but if you were to go up from here, that's ultimately roughly the high of the day here. And it just consolidates. You wouldn't want to trade any more than that. We go to the next day. See how it's here? It's magic, really. How the low of the day matches with when that turns blue. It's because price doesn't want to go much further than 5 ADR, which is the average daily range. So that's why it stopped. It's not because we ran out of volume, we ran out of this. It's nothing to do with that. Volume is nonsense. All of that's nonsense. All this order flow and stuff like that, and stochastics, RSI, all that is telling you past data and price. What I'm trying to do is show you things that predict the future. Okay, so I'm telling you things that predict the future. This is all stuff I've learned of ICT. So if you're not following ICT, go give him a follow. It's key that you are learning off the right people, and people who say ICT doesn't work is complete nonsense, and don't listen to them, because I'm showing you how it's more precision than any. Like, look, even when I'm just looking at Tokyo, which was before this session, cat reacts off that, bang on to the tick. Yeah, look how it comes up to the open range gap, sweeps this liquidity in London. Relative equal highs. Relative equal highs is when you've got the low on the right. This is like the most important. Everything you learn, this next point is the most important thing. If you've got a low on the right, a high on the right, that is lower than the one on the left, they're going to want to take that at some point. So here, the low on the right is higher than the one on the left, so they're what? Relative equal lows, and it will want to take that. So the low on the right is, the high on the right is lower than the one on the left. Yeah. So what we're going to assume, they're going to want to take this as well. And where are we in price? Here. Okay. We're what? Not a macro time. It's 12:30. So you're waiting for lunchtime, and what you're thinking, it's going to go up to here. Yeah. Where price is smooth, that's where you want to target. Okay. So when we were here, price was smooth here, yeah? So it targeted that. Then it come down, took out this low, and we're bullish on the day. So all it's doing there is manipulating shorts. And then, so if we decided to reverse here, why would you assume that you just need to take your profit here as well? I'm not saying it's a bad thing if you do, because that's the lowest hanging fruit, which is a good thing, that you're taking your profit early and getting into the rhythm of being winning. But if you're assuming, well, where's the next objective? So you look for the next high. So you got all these relative equal highs here. Well, where's the next one up? Well, could that be take profit 2? Yes. Smash through it. Then we reach up to this, but like if I'm looking at the next objective, where is it? It's here. But what's it going to want to do before it goes up there? It's going to want to manipulate people into thinking it's going lower. Yeah. It might even decide that it wants to like take out some of the bulls who've been bull all morning. So if I looked at the charts in the afternoon and I'm thinking, well, where could it want to target people's orders if it was to go down? Say, for example, we're getting a lot of a breakdown here. Where would I be targeting? Well, I'd be targeting here. I wouldn't be targeting down here, because this is where it's jagged. Smart money entered here. It's where it's jagged. Look at that big V. You're not like, there's no liquidity, not as much liquidity down here because everything got trapped in. The liquidity would have been if they entered here, but they would have moved their stops to here. So this is like the key area, is if the price was to go down. But then we're not at a macro time. It's what, 12:30. So like people here will be thinking, let's go short, let's go short. You ain't trading at the right times for a start. All it's doing is like the middle of this opening range gap. It's just trading around that. It's trading between these levels through lunch. Lunch tends to consolidate, which it's doing. So from 11:30, which is here, if we've had a big trend, and yeah, we've got a lot of people in, it can just chop around and just manipulate, create the new liquidity zones for the PM session, which starts at 1:30. So we're going down, down. Okay, between the two zones. But ultimately, we've broke away from this wick now. So I wouldn't be bearish on the day now. Like, it's shown clearly it's bullish. So why you reacted off this volume imbalance, the midnight price? Why would you be bearish? What would be the reason you'd be bearish? This is what people who trade like IC concepts or any concepts wrong, all they'll look at is the market structure. So, oh, we've got market structure shift here. But this low's been broken. Now we want to go down. Well, yeah, but you only want to catch bigger moves. You want to catch the general direction. You don't want to trade like a snippet potential to here and then it goes up again. Well, what's the point? You're just going to get stopped out because you're going to be greedy. You're not going to want to take profit at like 0.5 to 1. What's the point in catching that sort of move? Just stay patient and it will break up to this new day opening gap. Is it not wise to assume we couldn't reach this new day opening gap? We've reached this new day opening gap. We've reached this new day opening gap. We've reached this new day opening gap. We've reacted here. We've reacted here. We've reacted here. Is it not wise to assume it's going for this one as well? Maybe. But again, you've got to wait for the key times and see where the manipulation is. So if you've got a lower high that forms and it comes down a bit, that's perfect for me to go long later on in the day because that's where all the liquidity is and everyone's thinking it's going up. So you've got to get in that mindset. There's winners and there's losers of the trade. But if you're not marking out daily levels, then you're trading blind. This is what, like, if you look at all this off, take all this off. How are you trading that? Yeah, you can if you know about where the relative highs are. So here, relative highs are here, here. But if you took out the liquidity, you can just trade like that. But why not add resolution on your chart? Why not add the key levels on your chart? You might want to keep a separate screen because you don't want to trade with this on, which is completely fine. But why not have these levels of importance? It trades, touches the quadrant level, literally the exact quadrant level before it takes the liquidity, the upper quadrant. Yeah. It then trades to what? The middle of it. Reacts off the lower quadrant. All these levels are matching up. It's all algorithm that's causing it. Look here again. We're at what? Consequent encroachment in the middle of the opening range gap. So this is a trap. And again, we're at 12:35 now. So not key time to get in, but you can assume that eventually people who trade in their stop below, they trailed it to here, they'd have trailed it to here. So if we did want to come lower, we'd be targeting these lows as targets. But in my opinion, we don't. We want to keep up going. To everyone who was short in London session, who's hold their trade for a very long time, got the relative equal highs. That's where I'm looking at. And again, like, don't get trapped into that big. Oh, look at that. It's not the way to look at it. You've got to look at it like a game of poker, like a game of chess. If you're watching as well, just drop me a message and I can offer help and stuff. I don't charge nothing. But like any question, direction, I'll point you towards. Like even if you want to watch ICT's videos, I'll point you towards what videos of his to watch because he's got a lot of videos and I've had to learn all this stuff that I'm giving you pretty much at once, which is like what the hell's all this stuff on your chart. I'll point you to the right videos to watch, like the best ones. Like for example, I'll bring into another concept now. So I'm trying to bring in all these concepts that I know to show you. Let's see if we can spot. So you have to know about optimal trade entry as well, which we don't have an example of this chart, but I can sort of show you. You basically anchor the fib from high to low like this. Let me take off everything else on the chart so you don't get confused. These dotted lines midnight price. So if we're below midnight price wants to reprice usually to that. So like for example, let's get the sessions back on. If we're above midnight price, it's in London, it's prime opportunity to sell. I don't know where my Asia's gone. Oh, no, sorry. I don't use midnight so much for Asia because midnight starts at 0 GMT time. 0 midnight time, sorry. Then you get to London at 2 o'clock. These are kill zones, by the way, if you haven't watched previous videos. If you're new to this and you're seeing this, then the first time you're ever watching, for example, just make sure you go back over what the kill zones are. They're the best times to trade. Yeah, so I've got previous videos on that. Start on video one. The video one, if you're like know a lot about trading, might be a bit slow, but it's very important because I go a bit through time on there about like how the daily candle formed and a few concepts. So yeah, where was I? Oh yeah, over here. So like if I was to grade the highest point and the lowest point, yeah, then optimal trade entry would be in the lower half. Okay, so you think of it like if you want to buy something, you want to buy it in the lower half because that's a discount. If you want to sell something, you want to sell in the upper half, that's a premium. But you're thinking, oh well, this hasn't formed yet. I'll show you. Like, get the optimal trade entry levels on. So take a look at this now. This is like mind opening when you go to see how much this is algorithmic. So keep the 0 and the 1 on. Remove everything else and just put 0.79, 0.62, 0.709. So look how you grade that high to that low, yeah? And then look where optimal trade entry is. That fair value gap that I highlighted at the beginning of the video occurs at what? 0.709, which is optimal trade entry. Between this is optimal trade entry, so you could enter anywhere in this levels, yeah? So look how that occurs bang on optimal trade entry to go higher. You might be thinking, well, it's going to keep going higher, and I wouldn't have known about this high. Well, that's fine, because if you were to grade the times you do know about, from this high to this low, optimal trade entry just within this swing is this inverse fair value gap. Makes sense? So if you're targeting there, yeah, that's fine, but we could assume it's going higher than this anyway. So I'd want to like drag up to assuming my order's an optimal trade entry, which you're very good if you can do that, and you're confident in that. You could assume if I draw that up to 0.9, like this, pretend this never happened, or if all I did was anchor that low and draw an optimal trade entry to 0.709, we can assume what we're going to hit there. And then what? You don't even have to weather that retracement. Make sense? Here's another cool thing. Shows it's algorithmic. Go back to the take off all these. Put 0.25 on, put 0.5 and put 0.75 on. Again, it doesn't matter which way this is, like 0.25 should be down here or whatever, it doesn't matter. At each of the levels, you should spot a fair value gap. Okay? So, this is what I like to do to know like how far we can actually go sometimes, or like how far I can target. So I like to go like this. I'm trying to line up fair value gaps where we have like potential, but if I saw that as a swing, it doesn't work all the time, this one. It's a bit harder. But where you've got like fair value gaps that overlap, usually they overlap at the 0.5, 0.2 and 0.75. So you see you've got one here, you've got, so it should look a bit like this. So if you pinpoint fair value gaps at each of this level, so you see fair value gap, little fair value gap, terminus. Makes sense? So every level will have fair value gap, and then you can terminate the trade on the when we reach the top level. Yeah, that's a pretty simple idea that you could bring into a trading. But yeah, so I like to do that, like as I'm approaching like a potential target, try and zone and see if I can see is there a fair value gap at every quadrant level that I can spot. So if I was trading up to this level, which again is the middle of the opening range gap, then you could assume like these like fair value gap, fair value gap, fair value gap, terminus, and that's a simple way of projecting your orders. Which again, no one's looking at this. I'm telling you things that are like secret sauce almost. So yeah, if you like this, give me a follow, give me a message or whatever, and I can point you in the right direction to the source material of where this will come from and stuff, like where it talks more in depth. But I'm trying to keep this not too long because it's been about 45 minutes now. So I appreciate that, and I appreciate that if you've listened for this amount of time as well. But yeah, don't get sucked into people who say ICT is rubbish, because this ain't rubbish, I'm telling you. It's gonna change your life if you learn it. So, and again, I'm not false advertisement. I'm not saying I'm making millions of pounds or anything like that. But I'm saying a lot of his students are at that level. For me, just developing as a trader, and like everyone else, psychology, things like that, things that you need to develop to become the best version. So I'm not saying that. Um, so yeah, they're the main things that I'm using on every day. So I have trading sessions, new day opening gap. Yeah, I think this should do us for this video. But yeah, if you can sort of see, let's add all the levels back on. Let's see if it think of anything else I can see how around this midnight price. We'll just take that time. See how I said before, this was just manipulation. It is, because we're just working in this region. We wait till 1:30 and stuff, and then yeah, that was just all fake. You've got to think everything's fake. This is fake. This is fake. This move down's fake. This run up's fake. We were prior to 9:30. It would have been fine to target there and exit prior to 9:30. As soon as 9:30 opens, you're getting hunted. You're getting hunted wherever you are. This run down is being nullified. Nice run down if you traded London. It's all trying to target orders and book the market. So, which means all it's trying to do is efficiently target where all the orders are. It's not out to get you as such, but it is manipulating it and targeting the things and targeting people's mindsets. So it's all about mindset. The whole thing is like a big game of mindset. One last thing, last little gem that I've added as we go through, which I noticed that someone entered off a 15-minute candle for like a breakout here. You always want to enter as price on the book. Well, if you're going up, always enter as price comes down. Yeah. So like best entry you could have got was here, for example, where price was coming down and then you enter. Yeah. That's scary for a lot of people, which is why it plays on human psychology. Yeah. So it's human psychology wants you to only enter when the candle's going up. Yeah. So say, for example, the guy I looked up on TikTok, he entered here when price was going up, but he could have just waited for that retracement, like into like 50% of the level or 75% of the level. I'm trying to think what else I'm gonna say. Okay, yeah. So say if you were short on this day, for example, you got it completely wrong. You thought price was going to go down because it touched 25%, yeah, and you thought, well, it's such a big gap, it's not going to fill it, we're short on the day, etc., etc. So say you got it wrong, right? Worst case scenario, you can take a winning trade here. So you anchor from this low to this high. Oh, sorry, this low, because I'm trying to show you it as if price had formed like this. So say you're looking at the chart like that, yeah? That's what I'm trying to get in your head. You don't know this low yet. So you have to anchor from either this low or this high with your fib. Yeah? Or this low, this high, yeah? So you pick either one of those highs. Usually you want to pick the lowest one and the highest one. So let's do that. And let's put optimal trade entry back on. Let's remove everything else that you can see clearer. So say you've got that. Got this the wrong way up, so I'm going to have to remove it. Look at Sorry about this. Look at this. I haven't done this yet, so if you're short, it's that level. Friggin' hell, I've not got in the trade. Wait. 0.709. Then target's the low. If you use this level, don't worry about it. Same thing. 0.709 within the stop loss above. What trade lower? So you're using this optimal trade entry quite a lot of the time. Admittedly, when like price has gone up, you can't always look for an optimal trade entry, but keep it in mind because it can be used. Like you can't always look for optimal trade entry because if that's your model, for example, where you pick one thing that you want to use, an optimal trade entry, then yeah, you can use it. It's great. And again, just not getting sucked into shorts at all for the rest of the day. And okay, I think that sums up this video. But yeah, I'll make more videos if this was helpful. If it was helpful, give me a like and a comment or just subscribe so I know that you're interested. And again, I'm not getting many views at the moment, so I'm doing this out of the goodness of trying to help people. So if you enjoy it, appreciate any likes, comments, subscribe so that I know that I am helping someone. Yeah, new channel, so yeah, it's good. It's good that people again reacted off that middle. Just watch this. So coming into a macro time now. Got that. Where would you target though? You would target this one. These highs. See? It's not rocket science once you've got these levels out, you know all the PD arrays, you know where other traders are thinking. Because it doesn't bother me that other people are wrong because, like you said, they're the liquidity. Everyone's playing the same game. And it's funny because I'm not an arrogant person, and people who are saying they're right, they know everything, they're not humble at all, so they're never going to learn and develop. Yeah, they might be profitable, but at the end of the day, are they going to reach their full potential because they think they know everything, their strategy is the only one that works? No, they're not. So I'm not saying I'm the best trader ever. In fact, I'm saying I'm way far that, and that a lot of traders who are trading worse ways than me are more profitable than me. But it's not because this isn't better than what they have, because it is. I'm telling you, it's better because I'm showing you how precise it is, and that's not arrogance. That's just saying the concepts are better. I'm not saying I'm better, whereas everyone else seems to be thinking they're the best trader out there. They make the most money, blah 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 blah. ICT's rubbish and all that. But again, you've got to be humble when you start making money, when you win money, because it'll bite you in the arse otherwise. Um, Using this fair value gap, we trade it inverse fair value gap, we trade it up through it, we come down, the wicks touch it, the bodies haven't broke through it yet, and we're coming into a macro time at what? 250, so you can reasonably expect that price is going to want to keep going. And there's the candle just flipping over now. Just watch it for a bit. I appreciate this video long and probably not many people are going to watch the whole thing at all, but for those who are really interested, I just want to show. But there's a lot more to it than a market structure shift, a fair value gap. Here's a question. How do you know if something's going to be an inverse fair value gap or a fair value gap? How do you know? This is why everyone says fair value gaps don't work. There's 50% chance fair value gaps work. Yes, if you take every little fair value gap and try and target the way that fair value gap is, so say you're short, 50% time they'll work in. So, like this bullish one works, this bearish one fails, it becomes inverse. That's because like half the fair value gaps come inverse, half fair value gaps don't. So you got to pick the right fair value gap. And look, trading up at the macro time. you've got to pick the right fair value gap. So how do you pick the right fair value gap? Well, you've got to choose the time of the fair value gap. So in your macro, you've got to be right in your direction. That we've swept liquidity, we're bullish. So you're feeling these are good fair value gaps to use. If you didn't want to use these two, look what we have here. Another one. You might spot something here where you'll think I'm wrong, but here's another key thing that I mentioned earlier in the video. If you have like a normal fair value gap, stop loss must always be below candlestick number 1. So I'll show you the example. I've done this in the beginner videos, but I just want to show. If you have a fair value gap, you've got candle 1, 2, 3, stop loss must be below candlestick number 1. Yeah? So say you entered here, when a little bit of drawdown, barely anything, the bodies tell the story, the wicks do the damage, the wicks come down, the bodies, look how the bodies respect it. You might be thinking, if you're very good with your eyes, that this is a fair value gap, and this would have been a losing trade if I did that with this one. Here's the catch with using fair value gaps effectively. Say you entered off this fair value gap here, you see it? If there's 2 fair value gaps in a row, yeah, this is my rule for myself, and ICT teaches it. If there's like one there, I'll highlight this out. One, you're not on macro time, so I'm not looking at this for like entry, but if you were desperate, you had to get in this trade, and you could not see this go without you and not push down. Yeah, you had to get in this fair value gap for some reason. We're bullish, yeah, we had to get in this fair value gap. Your original stop loss, if you used candlestick, if you were too low, to be fair, you'd have been alright. But what I like to say is, if you had your stop loss too close, it would get wicked down, yeah, wicked out. Candlestick 1, 2, 3. Always have your candlestick below the first candle, and then you're safe still, yeah? So if there's 2 fair value gaps, have it below the candlestick number 2 of that first fair value gap that forms. Okay, like that. If you have 1 fair value gap, you've got to go below candlestick number 1. Make sense? So, little way of doing things. Anyway, let's end the video because it's 3 minutes and then it's an hour-long video. So yeah, give me a follow, give me a like, and I hope this was helpful. And peace out.